All right, my friends, with the market being 30% off its high, I mean, that's insane. It's insane. It's a crash of unseen proportions. I think, like I said yesterday, this is the third largest crash this fast. Or something like that. It's nuts. It's which would lead some who have cash on the side to think this is a buying opportunity. It absolutely is. Absolutely. If you got cash on the side, man, in my opinion, you'd be crazy not to put that to work. But let that be your decision. However, I want to caution you on something. When you're analyzing investments, the market decline will make the PE ratios look awful attractive, all right? Awful attractive. It'll make the dividend yields look awful attractive as well. I want to caution you on the PE ratios first, and then we'll talk about the dividend yields. The dividend yields are less concerning to me, but low PE ratios a little bit more so. So last night I was doing a live stream, and I was looking at VTV, because that's my biggest holding by far, the Vanguard Value Index Fund, and just like everything else, got crushed. I'm down 29.92% precisely. 29.92%, which is thousands of dollars, thousands upon thousands of dollars I'm down. I haven't been this low in my portfolio for a long time. Anyway, so I'm looking at VTV because I don't check it much. I just don't, because the day-to-day stuff is irrelevant to me. But I thought it'd be interesting. And lo and behold, the Vanguard Value Index has a PE ratio of, I think it's 8.5, 8.54 to be precise. And that looks very, very attractive. All right, you're sitting there thinking, whoa, a PE ratio of 8.54. It's in the single digits. That's freaking nuts. You're like, yeah, that's fantastic. And it's got a dividend yield now of 3.55. So it's a wonderful investment for someone who follows the factors of low values, high dividend yields, or low PE ratios, I should say, and low price to book values. We're certainly there now, like we've never been. So an 8.54% PE ratio that's basically 1979 proportion, when the Business Week had a headline on their August issue that said the death of equities, because the PE ratios were so low. But back then the bond yields were so high that it made sense for the PE ratios to be so low. But now the PE ratios are so low and bond yields are so low, that just says the stocks have only one place to go, up. But here's the problem. You ready? It's weird when a guy just drives by with a cigarette and his windows are up, you can still smell it. It's strange, man, how you can just smell. A guy just drove by smoking a cigarette in his car, and I didn't see him doing that, but I could just smell it because the windows are up. It's still, the smell permeates throughout just the neighborhood where I'm walking Pablo. It's kind of weird. I don't know if that's because I used to be a smoker and was raised by smokers, so I have a keen sense of the smell of cigarette smoke. I don't know. It's weird, though. I used to think when I was in the Army, I remember when I was at Ranger School, and me and this one guy, I forgot his name. Anyway, we'd be out in the, pulling, security or something like that. Just be literally smoking and joking, and we're supposed to be pulling security. We'd light up a cigarette, thinking, no one knew we're smoking. Right? And just now I realize that the smell of smoke permeates everywhere, and I'm sure in basic training and the Ranger School, the drill sergeants and our eyes certainly were able to smell somebody smoking cigarettes and would crack you if they wanted to. Just kind of funny. The ignorance of a young buck. All right, so let's go back. So now the PE ratio 8.54. All right, what's the PE ratio based on? It's based on current price with previous earnings. Current price with previous earnings, all right? So before the fall, the PE ratio on the value index was, I think, about 17, 18, something like that. And the dividend yield was like 2.5. All right, because the earnings are based on the end of the previous quarter. They're not forward-looking PE ratios. They're hindsight. So when you look up on finance.yahoo.com, you look at Morningstar or something like that, you will see a stock or an ETF. I don't know if they do in mutual funds. In this case, an ETF, and you will see a price, a PE ratio, and you're going to see what? A dividend yield. The PE ratio is based on the last quarter earnings. All right, why do I say you got to be careful for that? Because the last quarter earnings won't necessarily matriculate into this quarter earnings. In fact, I would argue to say this quarter earnings are going to be quite low relative to last quarter because of the apocalypse that we're under now. All right, so the earnings, let's say you had a $100 share price and you had $20 of earnings. All right, so in that case, you have a PE ratio of 5. I'm just looking, that's not real, but I'm just using that for example. A $100 share price with a $20 earnings, you have a PE ratio of 5. Now the price per share drops from 100 to 70, and I actually can't do that math in my head, so that's 4. That'll be 3 something, about 3.5, I guess. All right, so now you have a PE ratio of 3.5 because the price is 70, but the earnings are 20 still. All right. So a PE ratio fell from 5 to 7.5, from 5 to 3.5. No, to 3.5 from 5. That's a significant drop in PE because the price changed, but the earnings stay solid, stay static. That's not how it works, though. The real world, those $20 of earnings are going to change when the quarter one numbers come out. And the quarter one numbers, we're in quarter one as we sit here today. Today's St. Patrick's Day. So we are in quarter one. We do not know what quarter one earnings are going to be. Suffice it to say, I don't think quarter one earnings in that previous example will remain at 20. I don't. I think quarter one earnings will probably drop because business activity essentially for the last, a third of the quarter is going to fall through the roof, fall through the floor. So business activity falls through the floor, consumer spending falls through the floor, revenue falls through the floor. One could make an argument, which I don't agree with, that consumer spending was actually expanded because of the apocalypse and everyone wanting their toilet paper and whatnot. Yeah, but business activity is more than just going to Costco and loading up on toilet paper. Think about how many jobs of contractors were put on hold because people want to wait for this to blow over. I mean, just think of all that. And so because of that, you can easily see earnings dropping significantly and going into the second quarter as well. So what I would suggest is you'll see a PE ratio of 8.54. Going back to what I said about VTV, I would suggest when we get the numbers for Q1, that PE ratio will jump significantly because the earnings of Q1 dropped significantly, if that makes sense. Hope that makes sense. Now, part 2 of this is dividend yield. All right, dividend yield is simply based on the dividend per share. So let's go back to the example. Say you have a $100 stock and you got $10 per share dividend yield. A dividend payout, excuse me. $10 per share, $100 per share. Your dividend yield in that regard is 10%. All right. Again, this is not factual, just I'm using this for an example. Price per share drops from 100 to 70. And again, they're using the last quarter's dividend, actual dividend payout, to give you the current dividend yield. And this happens a lot with bonds and stuff. It drives me crazy. So last quarter, you got $10 per share dividend, but now the stock dropped from 100 to 70. I guess that's what, 16% or something of that dividend yield. So you get so if they continue to pay $10 per share as a dividend, and the stock is trading at 70, I don't know what this is off the top of my head. Let's just say it's 16. Your dividend yield went from 10 to 16. All right, so now your PE ratio is at 3.5. Your dividend yield is at 16. Whereas the PE ratio used to be at 5 and the dividend yield used to be 10. So now you're like, whoa, what a good buy. Well, I already talked about the PE ratio. That come quarter one numbers coming out, that PE ratio will probably jump significantly because, again, the earnings as part of that equation are going to drop. What happens with dividend yield? Well, I haven't read much in terms of companies reducing, never mind suspending their dividends. I haven't read that at all. But it doesn't take rocket science to figure if business activity slows down and companies are making less money, they're going to have a hard time to pay the dividend. I don't think that's too, I don't think you need a PhD in mathematics to realize that. However, for a company to reduce dividends is pretty drastic. It really is. I mean, it happens all the time when we get to some chaos like we're dealing now. But for the company to reduce dividends, especially the entirety of like the S&P 500, it's awful hard to imagine that in mass or a significant dividend decline. But it could. So anyway, at the end of the day, if you're looking at dividend yield, that's a lot more stable, I think. Well, I would know than PE ratio, because PE ratio are based on earnings, which change every quarter. Dividend payouts typically don't change much unless there is some significant earnings and profitability that companies have. But companies do not like to reduce dividends. I'm telling you, that's not a good thing. Now, if everyone's doing it like in 2008, that's one thing. If everyone said, yeah, we're going to reduce dividends because we can't afford this anymore, and we're not going to be held accountable for reducing dividends if that guy over there is reducing dividends and that guy over there is reducing dividends. In fact, if anything, if we're continuing to pay, people might say, hey, what's going on? Why are you guys continuing to pay when the rest of the herd is reducing? So dropping of a dividend for one company that's bad sign for that company. Dropping of a dividend for an industry, that's not a bad sign. That just means everybody's trying to bat down the hatches. So I could easily see the dividends dropping a little bit, but I'm not nearly as concerned with that as I am about the sudden jump in PE ratios come reporting for Q1 of 2020. All right, hope that helps. So just be careful. Be careful before you say, whoa, stocks are cheap relative to price earnings ratios and dividend yields. Again, I would look at dividend yield on stocks, on index funds in particular, or a broad-based market. That's not just a couple holdings, a lot more with a permanence than I would at PE ratios for sure. All right, we'll see you.